Hello and welcome to another episode of the Opportunity Podcast. Today I am speaking with the founder of Credit Suite, the founder and CEO, Ty Crandall. So Credit Suite is a very interesting business. They have a software that helps you build up your business credit, but they also have like this crazy massive vendor and relationship network to get all kinds of different types of loans. Ty is probably one of the most knowledgeable people I met when it comes to just like obscure financing, like very obscure financing. And this all came about, as I will say on the episode, like me just like applying for credit cards myself. And then I'm always thinking about like, what are all these different creative ways that people can go and buy a business, right? And you hear the gurus on YouTube, they're always talking about no money down deals, and those deals do exist. But in order to do those deals, you still need to pay the seller a lot of money. So where's the money coming from if it's not coming from your own pocket, right? So Ty, he's educated a lot of people on acquisitions, of using debt responsibly, of building up your business credit. We kind of do a little tongue-in-cheek laugh at the mention, or at least I laugh when you mention Dave Ramsey, because obviously if you're in the Dave Ramsey crowd, you're probably not going to like this episode because we do talk about debt quite a lot. Personally, I think debt is an amazing tool. I think it's a much better tool than what my entrepreneur friends typically do, where they raise money and give up equity. I think debt is often the better solution for a lot of those businesses. But with that said, I don't want to steal Ty's thunder. Let's get into it. I think you guys, if you're in the market of buying a business or you just want the ability to have more credit where you don't have to use your cash, you can let that cash sit in reserve. This is a really good episode for my entrepreneurs at every level, basically. All right. With that said, I will talk to you soon and see you on the other side. All right. I got the founder of Credit Suite here, Ty Crandall, and I was just talking to him offline how I've been like stalking him on the internet here for the last couple of weeks. Chatted with one of his sales guys not too long ago. And it's about a topic that I think is extremely exciting, which is business credit. So I told you, Ty, I found you through just like me going down this rabbit hole of personal credit stacking for myself, which led into business credit. And I'm always interested in creative financing. I saw you give some talks on using creative financing to acquire deals. So before I just like blow up your whole biography, why don't you introduce yourself to the crowd that is not familiar with you and what you do?
Hi, Ty Crandall, CEO at Credit Suite. And Greg, by the way, thanks for having me on the show. I'm excited to be here. So what we really do is we focus on getting businesses capital, and we really do it with a unique combination of in making a business funding ready, figuring out the stuff that gets them denied, where they're either not getting as much financing they want or the rates and terms that they want to get, or getting as many approvals as they like, fixing those things. And then we also help a business build business credit profile and score and use that for the business to kind of fund itself. And then at the same time, we work with every legitimate type of business funding that's out there to be able to get our clients the most funding, oftentimes by stacking different types of funding, even when they think they can't get approved, to be able to get the maximum funding. So our ultimate goal is to get somebody the most money at the best terms through that combination of ways that we do it.
Love it. Yeah. So I think the best way to begin it, because most people are not familiar with business credit. Also, maybe we start off first defining that a bit. Like, how does business credit differ from personal credit?
Well, they're similar in a lot of ways. You know, if we think about consumer credit, it's linked to an owner or an individual social security number, right? And it basically is a reflection of your ability or what your history of paying your bills as agreed. And then that also gives lenders and credit issuers a reflection of your ability to be able to take on other debt and to be able to pay other debts back responsibly. So business credit's really no different. It's just the difference is that it's linked to a business's EIN, not a business owner's social. So if I build a business credit profile and score for my business, then I have business debtors, lenders, and credit issuers looking at that credit profile to determine if my business should be lent money. So the better I build this credit profile and score, then the less they need my personal profile and score. So we get to a point where the business can qualify for its own credit, ultimately even its own funding, without needing the owner to sign for guarantors and be able to sign with credit checks, personal credit checks. And that gives a business the ability to borrow like substantially higher amounts of money. So SBA says that, you know, business credit limits are 10 to 100 times higher than consumer credit. So if you think about that on the minimal end, if you've got $10,000 consumer credit cards, to get to 50, 100,000 is very easy in the business credit space. So because businesses have greater appetite for money. So a lot of similarities. It's just, you know, business credit reflects the business's ability to pay its debts, and a consumer credit profile and score reflects a consumer's ability to do that.
I'm probably going to be skipping around here a bit because there's a lot of interesting things you just said there. But I have a good buddy. He has his own debt shop in San Francisco. He deals with private capital markets, and we were catching up. I was telling him about how a lot of buyers for our businesses, they'll start getting cold feet with SBA because of the PG. He's like, PG, what do you mean? Like personal guarantees. Like, oh yeah, I forget those exist. Like, what do you mean you forget those exist? They're like on every loan. But he's playing like a whole different level, right? Where like that's not normal. But then I found you, and you're also talking about this. So walk me through, why is it that what kind of business credit can you get without PGs? Like, and how do you get to that level where you can qualify for these kind of loans without PGs?
So the root of it, we have to think about what a PG is, right? I mean, a personal guarantee is you basically saying, hey, if the business default, I'm the signer, my personal assets,
Mm-hmm.
we can come after my personal assets. Then we think about this on a really large scale like Dell, right? Well, Michael Dell is not signing PGs on Dell's debts. And we laugh about that and say, of course, because it's Dell, but it's not because it's Dell. If you look at Dell's business credit report, Business Dell's credit report reflects 50 years of responsible borrowing. They've been given $100 million credit lines they've paid back as agreed. They built a credit profile and a score that allowed them to get their owner where it doesn't matter the equation, the business can stand on its own. By the way, Walmart was exactly the same way. If you've ever read Sam Walton's book, Sam talks about this in a book where in the very beginning, he'd go to Tennessee and buy things wholesale from wholesalers. And he would talk about how he knew they were going in the back room to pull his Dun & Bradstreet credit profile. This was in the 70s, right? And then they would come back and then they would ultimately extend him credit. And this was him personally, right? So in the business when it very first got started. So what we see here is that as a business grows, and by the way, today's date, Walmart, 80% of what that company buys, they're using business credit to buy. So they're not even using their cash, they're using business credit to buy. But all businesses start fundamentally at the same level. They have no credit profile and score. And then privately owned or publicly owned, we start to build a credit profile and score. The bigger we build the credit profile and score, the more types of capital become available to us without personal guarantees. SBA loans, you're always going to need a PG. Just the way it is. SBA is going to require a PG, right? But when we start building business credit cards, you just do not need PGs for any kind of credit card. Like if I'm getting a $50,000 credit card at Best Buy or $100,000 at Lowe's, or I'm getting a $50,000 Visa card, I do not need personal guarantees for that. I could build a credit profile and score in the very early stages, months into opening a business. No credit card I should need a personal guarantee or credit check for. Auto financing is another one of those. One of our clients got $350,000 at Ford. No PG, no credit check. I mean, he went to buy a truck, and I can't even mix up. He literally launched a Turo business because they gave him like hundreds of thousands of dollars.
Accidentally started a new business line because of the credit line.
And he's a partner boy, so he signed up like the finance manager as his client. It's like, talk about a pivot. But so like auto financing and credit cards, early stages, less than 6 months in, you start to get more and more and more of that. You just don't need PGs or credit checks. Then we look at other kind of stuff that really a lot of collateral-based lending, or what's called asset-based lending, where you're pledging an asset as collateral, stocks, bonds, 401ks, IRAs. A lot of that stuff also does not need PGs. So even equipment lenders, some require them, some don't. But a lot of that stuff does not need personal guarantees. Revenue lending, where they lend you money, MCAs, where they lend you money based on revenue. A lot of revenue lenders will require a PG, but a lot won't. So a lot of that kind of alternative financing you can get, especially as you're building business credit, if your credit profiles and scores are good, without PGs and credit checks. Now, eventually, you'll even get into bank lines of credit. You'll get into bank loans. It takes a lot of established credit to get there. Like most of us, small business owners will not probably see that level, but very large privately and publicly owned companies do get to that level. So it kind of gives you an idea from the startup to really when you become big of what's available in the no PG realm.
Yeah, so I think maybe what would be useful to back up a little bit to describe like what makes good business credit versus personal credit. I know there's a bit of overlap. I've also heard you talk about these like tiers. Maybe we can go through I think there's like 4 tiers you talk about. Maybe we can go through that real quick as well. So what makes up your business credit score? And then what are these 4 tiers that you talk about?
So business credit's phenomenal for so many reasons. And one of the reasons is, when we talk about consumer credit as you started, the personal FICO score is a mess. Because if you really look at trying to improve one part of personal FICO, you damage another. So an example is, 10% of your FICO score is a consumer's credit mix. So I have to have the right mix of credit. But when I try to apply to get new credit, then I damage the inquiry section or the 10% that relates to new credit. So it's like I try to help one, I hurt the other. I try to have payment history. So I use my accounts, but then utilization is 30% of my score. So as I put balances on, I lower my scores. So it's just this tug and pull. And it's why it's very hard for us to get 800 plus credit scores unless we have a long time of established credit. Business credit scores are really interesting because the main scores that the reporting agencies use are based on one factor and one factor only, which is how you pay your bills. If you get accounts that report, you can immediately be given a good score. Now, when we first started consumer credit, FICO wouldn't even give us a score for 6 months. In the business world, they will do it immediately. Like, so the minute that we have accounts reporting, 3 with D&B, 1 with Equifax and Experian, they will create a profile and score. And our scores are just based on how we pay the bill. And the score is based on, do we pay it early? How early? Do we pay it on time? Do we pay it late? How late? 30 days, 31 days, 41 days? I mean, I even have an interesting slide I show sometimes. This is if your score is like 61 with D&B, it means exactly this on average. So all we have to do with business credit is we have to get accounts that report, which is one of the hardest parts because 90% of these trade vendors that issue credit don't report it to a reporting agency. That's our hard part. But when we get credit that does report, if we just pay it on time or early, that's it. It's the only thing we do. We are going to guaranteed have good business credit scores. Guaranteed. The more accounts we add, the more accounts that we continue to pay on time or early, the more our scores will lock in, stay there on an average. Now, don't get me wrong. Like, Greg, there are other business credit scores that each bureau offers that takes into account public records and other stuff. But I don't even care. All of those scores, if you just had accounts on there, 10, 15, 20 accounts that you paid as agreed or early, you'd have good scores across the board with the bureau. So that's the only way that the scores are actually really calculated. The only thing you need to worry about to get good scores. Before we get into the tiers, I'll stop there just in case that brings up any questions.
No, yeah, that makes total sense to me. I guess the question I would have is, like you mentioned, a lot of people don't report, which makes sense. I mean, a lot of entrepreneurs don't even know this exists. It's kind of like almost a weirdly niche aspect of business, which it really shouldn't be. This seems like very important things for entrepreneurs to know about. When you're mentioning these different lines of credit, does things like a Chase business card, for example, would that be something that reports to DNB and these other business credit reporting bureaus? Like, are business credit cards like part of these trade lines that you talk about?
It's a phenomenal question. And if using Chase as an example, the answer is sometimes.
Sometimes.
Sometimes some of Chase's cards do, and some of Chase's cards don't. But I will
Interesting.
tell you that probably 8 out of 10 of them don't. It's just kind of a mess. And let's just look at Capital One, for example. They have accounts that report to both consumer and business credit. So usually you're kind of in one of these areas. You get a Chase business credit card, and it still reports on your consumer credit report, or it reports on your business credit report, or it reports nowhere, or it reports to both. And literally, Chase has credit cards that are in every single one of those categories. So you have to ask. And what we teach our clients is like, you have to ask. So I got a PNC Bank credit card application the other day. It looked really appealing. So I call PNC and say, I have 2 questions on this. Which bureau are you using to pull to make the decision? Like, I want to know, are you pulling consumer or commercial credit or both to make your decision? And the second thing is where do you report my timely payments? Now, I don't know about you, but I've been in business long enough to hear the delay or not delay. They either know what they're talking about or they don't.
Right.
You know what I'm saying?
Yeah.
And like, if they
Yes.
don't know, I'm like, thank you. And I hang up and I call back. And I call back and I just call back to somebody that says, oh, we pull from TU and Equifax and we report. I'm like, great. And so when I get somebody that really I can tell is knowledgeable, and if I can't sense that, which most of us entrepreneurs can, then I'll go take 2 or 3, or I'll get 3 answers and go with the one that, is 2 of the 3. But, when we suggest our clients, I don't even get a credit card unless I ask that question to know, do they report or do they not? And so then in that case, I might go to them if they're knowledgeable and say, well, look, I want something that reports and helps me build business credit. Which of your cards would be best for that purpose? And if you have a knowledgeable person on the line, they can even guide you to, well, we have this card or this card that can actually work on that purpose. And again, then there's a second layer of that, which some of them are using business credit to make the decisions, and some of them are using consumer credit. And so it's just interesting. You really have to go in with the right information. If you have an established business credit report, to say, I only want to apply using this, no PG, no credit check. And I only want like cards that report like which of your cards report. And that will help guide you to the right ones that do.
That makes sense. I think I saw you on one of the things I watched of yours over the last couple of weeks, where you mentioned like, yeah, banks are not going to tell you this because like, why would they? They would prefer you to get the PG for obvious reasons. So It does make sense. It's a bit of a mess. Okay, let's get into the tiers because I thought this was very interesting when you brought this up. Because on one side, it makes a lot of sense for like the majority of businesses. My audience are mostly digital owners, so I think it might be a little bit different. But briefly describe these like four levels of tiers that help with business credit.
Sure. Let me start by saying they're completely made up. 100% we just made them up.
Great.
They don't even really exist. So like if you think you're going to go to ChatGPT and anywhere else and try to figure this stuff out, we just completely made this thing up. But we made it up because what we realized was this insane thing about business credit reports, that the more accounts you have on your reports, the more credit issuers will start to approve you. And so what we realized was that the key to business credit building really came down to one core fundamental: the number of accounts you have on a business credit report. And not only did that control the ability to get other kinds of credit, but it also directly coincided with the Bureau's recommendations of how much money you should actually be issued. So I'll do webinars and I'll pull up business credit reports. I'll say, here's somebody with 2 accounts. Here's the credit bureau's recommendation at $2,500. And I'll go all the way up to show real credit reports with 15 accounts on them where the bureau says, give this guy $724,000. So the more accounts you add to a business credit report, the first thing that happens is it opens up more types of credit you can qualify for. The second thing it does is it's raising the bureau's credit limit recommendation that credit and lenders are tapping into to determine how much money you should be lent. So what we want to do is add as many accounts to our business credit reports as we possibly can do. And then that opens up more accounts we can get without a PG. And then it opens up more and higher limits and higher approvals, higher loan amounts, higher credit lines, higher credit cards. So the tier system is just a system that we broke down, and it fluctuates all the time because it changes all the time. But it's these credit issuers will give you money if you have X amount of accounts on your business credit report. So an example here is that if you have 0, well, then we want to start with a Uline of the world, a Granger of the world, a CEO of the world, right? Or CEO Creative, I should say. And these credit issuers will give us credit when we have none, and they report it to a business credit reporting agency. Then we start to get initial accounts on our business credit reports. Then we can start to move to the next tier, which are retailers that, could be like Amazon is a really good one. Dell is a really good one to be able to get. And that next tier where we start to have, 3, 4, 5 accounts on our business credit reports. And then we just continue to move up. And I can't tell you credit issuers that are in each tier because it literally changes daily. Our tech sees this like one day Lowe's requires 7. The next day Lowe's requires 10, while Home Depot requires 8. It just fluctuates all the time. And that's kind of like what our software does, is it shows what is in any given tier at any time and what you can get. But that's how the tiering system works. It's just to know that if you apply for Home Depot and you get denied without a PG and you say, that Ty Crandall guy is a liar. Yes. No, it's not true. The problem is you don't have enough accounts yet to get Home Depot. If you go and get other accounts and then go back to Home Depot, you'll see Home Depot will approve you. Even though their page says you need $1 million in revenue and 2 years in business, it's horse crap. It's absolute horse crap. If you have enough accounts on your business credit report and you've been open for 2 months and make $50 a month in revenue, they will approve you if they see enough accounts on your business credit report. So that's how the tiering system works. You just get more credit. The more tiers or types of credit become available, the more credit you add to your reports.
Gotcha. So it's kind of like the personal credit score is like the higher your maximum limit, the better, as long as you're not like utilizing it. I think business credit works a little bit different than on the utilization front, but it's the classic, like banks and people will lend you plenty of money when you don't actually need it kind of thing, right?
Yeah. Yes. So. And it is similar in that way. Like in business credit, 100%, it's interesting we talk about utilization. So we'll talk about this for a second. If you look at your business credit report, it doesn't even show what your limits are. Nowhere on the report, nowhere. It doesn't even show. What it shows is the recent amount of credit you've used. So the bureaus in business are telling us that by getting accounts and using those accounts, that is directly what's going to link to getting us get higher and higher approvals. So in that way, consumer and commercial credit are very similar, that the more that we use, the more that we're using credit, the more the companies want to give us more because they see that we're actually using it, right? And it continues to raise up. So that is a very accurate thing. But the difference in the business world is they have this extra layer of credit limit recommendation from the bureaus that we don't see in the consumer side. Like we don't pull our consumer credit report and say, hey, TransUnion says give this guy 50K. We don't see that. But in the business world, it's on our reports. Like it is directly there. So that's another layer where they're giving, based on all of their analytics, information to lenders and credit issuers of this is how much you should think about giving this person based on the credit card that you're issuing to your credit card company or loan or blah, blah, blah.
Gotcha. So to recap, just to make sure I'm understanding right, because I want to move into how this might play out differently for like someone in my audience a bit. From what I understand, like Granger, Uline, like I think Quill's another one. These are like accounts that approve you like relatively easily, even like you said, $50 a month in revenue. Oh, sorry, is that not true?
Quill is no longer one of those
Oh,
accounts. So
okay. That's one of the ones I changed.
They're one of the ones that used to be a great starter vendor.
Gotcha.
Now they're not. Now we have them like as a tier 3 vendor because they're just not good for that purpose. But I didn't mean to interrupt you.
No, thanks. Thank you for correcting me. So a lot of these trade lines, from what I understand, the trade line works for you buying things from them, like the office supplies or whatever it is, right? For someone that is like you mentioned, like gas fleet cards, there's like kind of part of it too, which for a lot of local businesses makes a ton of common sense. But say you're running a marketing agency, or say you're running an Amazon FBA business, like maybe you're doing the digital nomad thing in Chiang Mai, Thailand, right? American, it's an American business, you're American, but you're just in Thailand. Like you have no need for the Dell trade line necessarily. Well, maybe you do, but probably unlikely. Like in that kind of setup, where it's very much a digital native business, how does the like figuring out the tiers of how to build this like change, or does it not change at all?
It doesn't change. What changes is what you need the money for. So you just gave some good examples. If I'm a plumber, Home Depot, Lowe's, Labor Ready, home runs. I'm from Indiana, Tractor Supply, John Deere,
Sure.
home runs, right?
Yeah.
And then if I'm like, here, I'm a digital guy. Like everything I do is digital. I don't go drive cars around. So if I look at what my setup here from, I've got my cameras, my high-end cameras, I've got my lights, my light systems, I've got my monitors behind me, I've got my printer, I've got my stand-up desk, my chair. 100% of my setup is business credit, right? So whether it be IKEA, whether it be Best Buy, whether it be Office Depot and Staples and, any number of different office places, name it. All my equipment, my laptops, it's all business credit, like Apple, right? I can drop some money in Apple. I can drop some cash in Apple. So I'm using business credit to get my phone from Apple. And then all of our team members, when you're hired here, because we are virtual, so we don't have physical office, then every team member gets a laptop. Well, that's all Apple. So we're using business credit to run the business. We're using business credit to expand as we hire employees and for all of that stuff, right? Then you get into companies like Creative Analytics, Creative Analytics does legit digital marketing services, or you get into places that do swag. So I'm here, on this podcast, this is business credit. Like I used it to buy swag, you know what I'm saying? So like all this stuff is all business credit, or, we can even run Facebook ads and Google ads and stuff like that from companies that offer the digital marketing services with business credit. So a lot of that other stuff, it just depends on what you're using it for. And what I say to a business owner is you need to really put down on a log not what you're spending money on, what you're buying. Usually 80-90% of that stuff business credit can typically pay for. But if I'm in trucking, it's paying for my gas. It's not paying for my stuff, And,
Sure.
and if I'm different, what's different than a plumber? And so it's just what you're spending money on and what kind of card you're going to get and use is the only thing that really changes. The tiers and all the rest of the stuff stays the same.
Okay. So yeah, that was like one of my questions, because it sounded like most of the examples I heard would not be something that would be easily accessible or even very useful for a lot of people in my space. But it sounds like there's a ton of different vendors. Even if you are that like Amazon FBA entrepreneur in Chiang Mai, there's ways you can do this for your EIN even while you're doing the digital nomad live.
Yeah, I mean, the easiest way to explain it is like almost every major retailer offers a corporate card. Amazon, Walmart, like I don't care what business you're running. Like we're buying stuff.
There's a lot of people out here in Asia that pay exorbitant shipping fees to get stuff from Amazon. So out here we have Lazada, which is like a crappier version of Amazon. Sorry for anyone that works at Lazada, but yeah, so they'll just like get like people to fly in their Amazon shipments to
It's like
Asia.
But talk about flying, right? And then we got American Airlines. We've got all the credit cards. The airline credit cards are all part of business credit. We've got all the hotel, the Marriott, the Bonvoy, all that stuff is all business credit.
Oh,
So
yeah.
hotel,
Yeah.
flights. Yeah. it's like, it just depends on what you spend money for. But if you're spending money at a retailer, even if it's an airline or a hotel or a retailer that sells any kind of anything, then they typically have a corporate credit card. It's just the retailer you use is different than what a trucker's going to use. Your needs are different. That's the only thing that changes.
Gotcha. Okay, this makes more sense for me. And yeah, on the card stuff, like I have friends that basically fly business and first class all the time for free just because they're spending so much on ads, right? So that was why I was kind of curious about the Chase one because I know they have I think it's like a 1x on credit for paid ads or something like that. But yeah, okay, that makes sense.
Everything you spend money on in your business, you use your credit card for. Everything. Like payroll. Why would you not? Like if you have cash in the bank and you want to pay payroll, why would you use the cash in the bank? Pay your Amex and then take the cash in the bank and immediately pay off Amex. Like, why would you not? You just do the math on points. Like it's literally exactly the same transaction. There's zero interest involved. And yet you're getting the cash and you're also getting like what, 2%, 3% cash back. That's like an instant 2 or 3% bump to your margin, like just by doing that one thing. So everything you should do. And then that credit card can be obtained without a guarantee and credit check. So it's like, why would you not spend everything on the business on a credit card and then just use the cash to pay off the credit card? And then you're instantly increasing your margin by 2-3%, getting points and all the other stuff.
I have a funny anecdote that plays right into what you just said. So I don't know if you're familiar with like paid media affiliate marketing, but it's extremely cutthroat, right? Like you have to be like very good to make it work. And the margins are very, very thin. I knew a guy who was doing like $50,000, $80,000 a month in profit. And the reason why he was able to do it and none of the other affiliates is because of the cash back on the credit card was able to increase his margins just by a little bit that made the entire thing profitable. And like I have so many friends who have run those campaigns that are like razor thin margins. So just like even like 1-2% more, suddenly they're like going to the moon in terms of their profit. But yeah, it was through business credit.
Yeah,
I guess.
listen, I've got guys that do it. They take the cash back. I've got guys I know that then put it in crypto. And then I've got other guys that put it in gold. They put it in precious metals. I mean, it's like they have these insane strategies, but they work. And then these things are, fluctuating, but then they'll get up and they exit. I swear to you, I can't even make this stuff up. Then they exit at the highest level. Then they take the cash and they buy businesses with it. It's like it's a game at a level that most people don't even think about. And that's just by normal spending in their business. But doing it wisely, using it on credit cards, using the cash back, taking the cash back to invest, then taking the rewards of the investment as cash back and then deploying it in another way for business acquisition. I mean, it's just crazy. There's no end of what you can do.
I want to get into this next question. And I want to talk a little bit about the risk before we get into the acquisition stuff. But my own father, he built his real estate business up in Alaska on credit cards. Like he has a really good personal credit score. I don't think he was using business credit at the time. This is like the 80s. But you get all the 0% APR, right? Just cash it all out, like max it to the brim, buying houses, flipping houses, helping people sell houses. To get another 0% to pay off that one and just like kept doing it. So he has like a little safe about this big, just like 50 old credit cards from those days. And that's how he funded his little startup in Alaska. So yeah, I know it can work. I know you talk about that too. These like kind of intro rates, I think it's like 12, 16 months or something like that. So we'll go into the risk after this, but how can entrepreneurs get access to this kind of like 0% interest intro cards that I've seen you guys talk about?
We call it credit line hybrid. It's called credit card stacking out in the world. They really are credit cards that you're getting. And the way the system works, our newest software we're going to roll out next year actually gives you the ability to stack your own. It actually gives you the whole funding plan you could execute, so you don't have to pay a source to do it. There's plenty of sources out there. We can recommend you to it. No cost on our end. They charge 8, 9, 10% to be able to do it. But what they ultimately do is they come in and find all the credit cards you can qualify for. And then what they'll do is they'll actually stack them and apply for all of them at once. And there's a more complicated system of what they do than what I'm explaining. And then that way you're getting 5 to 8 times more funding than you get on your own. If I go get a Chase credit card today and then a Bank of America tomorrow, Wells Fargo, by the time I get to Wells Fargo, they're either not going to approve me or approve me for way less because they know that you're applying at the other banks. But they actually have a third-party data aggregator that all banks are part of, all of them, and they all equally share data. We don't know this, but like when you apply at Wells Fargo, Bank of America instantly knows what took place. Like it's just, that is the way that it actually works. So what happens is they're coming in at the exact same time and applying to be able to get you 5 to 8 times more money. Typically, like we see startups get 50 to 150K and that kind of credit, 0% for 6 to 18 months. And then really common in a lot of industries, including to your example, real estate to this day, where then they'll cash out the 0% at 0%. So you're taking cash out at 0%. and then using it for acquisition of properties. Or you don't have to take the cash out. You can just use the cards for whatever it is you're buying. And then to your point, you rinse and repeat. When that 0% period expires, you either try to negotiate to get that back down to 0%, or you just abandon the card, shut down the card, and go back and apply for a new credit card. It's the simplest way to describe the process, although there's a lot of nuances involved in it.
Yeah, of course. And anyone listening to this, like, I could see the Redditor comments now, like, oh, this is ultra risky, which, hey, yeah, it is. But, business is risky. So talk to me a bit about the risk side of this, because that'll give you a bit of context. So I have a lot of entrepreneur friends. We sold over 2,500 businesses at this point, made a little bit over, I think we're at 93 millionaires at moment of exit that we've helped created. And a lot of my entrepreneur friends, they'll be like, jumping for joy, popping the champagne bottles because they raised all this money by giving up, like, say, 25% equity in their business. But then when it comes to debt, like financing debt, they're like, whoa, that's too dangerous. Like, these guys are charging me a 25% interest rate. Like, well, man, these investors, like, the banks want $25 on every $100 you're borrowing, right? Investors want a lot more than that. So it always, like, drives me a bit nuts, like the way people view debt. But I know a lot of people are afraid of using debt. There's like an unhealthy relationship at times. So what do you say about the risk? Like, what should entrepreneurs know about the risk side of using business credit?
So I think, first of all, I'm an entrepreneur. So, like, I'm not the guy to talk to if you want to.
You're a bad role model to talk
We're a
about
role model for that. Wrong question asked, wrong guy, but that's okay. I'll do it anyways. I just want to get that disclaimer out. So I don't think there's a right answer when it comes to debt or equity. I think it just depends on personal preference and how you look at it. Like, I'm the kind of guy where I built and exited multiple 7-8 figure businesses. So for me, I've done it all bootstrap with debt. I've never taken equity before. And that's because I'm an ex-military guy. I learned really at a young age that I don't do well being told what to do by other people. Like, that doesn't work really well for me. So, like, having an investor come in that has the ability to tell me what to do and guide, like, the vision of the company, that's just not a good fit for me. It's just not a good fit for me, right? But others, it is. Others can find the right strategic partner that could come in on the equity side, give them money in exchange for equity. And that partner could be a phenomenal addition to help the organization go to a whole other level. And we've all heard horror stories and success stories in both sides of that, right? Like, there's lots of them out there. So I don't think there's a right or wrong. I think that some people do a combination of both. I think there's nothing wrong with using loans and credit lines and credit cards. All the biggest companies do it. There's zero of the largest privately and publicly owned companies to this day that don't do this. Zero, right? If we look at Apple right now today, Apple, let's say they're worth $130 billion. They have $100 billion in debt. Now, any low-risk person is going to go, like Dave Ramsey steward, is going to go, I don't know what to do. You know what I'm saying?
I had a feeling we might be making fun of Dave Ramsey before the end of this conversation.
Realistically, that's what they're going to say to do. But Apple wouldn't be the most valuable company, like one of the most valuable companies in the world, if they did that. Like, think about this. 80% of what Walmart sells, they're buying debt. They're using debt to buy it. They're literally laying out credit cards. And when you walk in Walmart and you walk on the shelves, 1, 2, 3, 4, 5, 6, 7, 9, 10, 8 to 10 of those, they used credit to buy. Then they take your money and then they use it to pay off the credit. Now, that's why they have 10,000 stores, because they're saving cash and investing cash on growth. So, every one of the largest and privately owned companies out there, all of them, even including Facebook and all the ones that took VC to go through, all of them use debt. 100% of them use debt, even when they used equity. So I just don't think you could really build a really, really successful business without debt being involved, because I've never seen it happen 100% of them. And sometimes on lives, I'll poll, because it's all public information, I'll pull their business credit report. I'll pull Dell, I'll pull Apple, I'll pull, every one of them, HP. I'll pull the Trump organizations when he's running for president, Clinton's organization. Pull them all at the show. So it's like they all run off debt. They're all accumulating debt. So I think you have to involve some level of debt, because I've never seen a business reach that level of success without it. Even if you're bringing in equity, I think that really successful scaling business is a smart combination of both, using equity and using debt, just using debt responsibly to minimize the risk, just not overspending, not overextending yourself. Just some common sense principles have to come into play there.
I agree with you. And for my listeners out there, I think you said something that's very important, that it doesn't get lost in what you said. But you mentioned bringing in a partner on the equity side that, could be phenomenal for the business, like strategic, a lot of good advice. I think a lot of my entrepreneur friends, they get a bit blindsided. They think they've got a victory lap because they raise all this money from equity, but the equity partner isn't giving them any advice. The equity partner just gave them money. Like they're like a passive investor. And I don't know how you feel about this, but I tend to feel like, well, if the person wants equity, they got to bring something to the table outside of just money. Because if it's just money, I feel like debt is always the better option. Like, what do you think about that?
100%. I mean, I wouldn't bring in a partner into my business if they didn't provide value and they just gave money. And then the other thing is that like, I don't even know with human psychology if we're capable of spending, our own money the same way as somebody else's. Like, I don't think it's possible.
There's a reason why a lot of people raise money, go broke because of all the
Sure,
money
absolutely.
they just like run through it, right?
Like
Yeah.
the majority of those VC investments fail because they're out popping champagne bottles. Like, I mean, we've stuff on Shark Tank where they talked about they were at these extravagant parties and then the shark realized that it was their money
Right. Yeah. Yeah.
was used to host the party.
That literally just happened in like one of my friend groups. So there's a big crypto community out here in Vietnam, and there's this guy. I think it was like $10 million, something like that. He's just going to all the crazy clubs, like popping champagne, and the other part's like, "Dude, what the hell? Like, we need this money for the business." He's like, "I'm the money guy. Don't worry about it." Like, you're spending all the money. So yeah, that definitely happens. Well, let's transition a bit here into acquisitions because I like that was something I think my audience need to know the base, but talk to me about how we can use creative financing, what you're talking about, to actually go out there and acquire businesses. I know that's a very broad question, but give me like the 101 here of how you think about it.
So I think the easiest loan to be able to get for acquisition is SBA. There's two really
Agreed.
good ways to go. One, not a lot of people know about. The first is SBA, and SBA will usually finance up to 80-90% of a lot of business acquisitions. To your point, what we discussed earlier, it's hard on the digital side because in a lot of those cases, the SBA is going to require debts to offset what you're actually borrowing, right? And that's in SBA's guidelines. They're required to go after everything they can collateral. And if business doesn't meet what they're trying to borrow against, then they go to personal. They start taking personal assets, homes, and all that stuff as
Oh,
collateral.
SBA doesn't do PGs if you have other like business debt on or other assets within the. I thought it was always PG regardless.
No, they're going to PG.
Okay.
They're going to PG.
All right.
Now, what their underwriting guidelines state is that they are basically equipped through the lender, because keep in mind, SBA is not lending the money in a lot of cases. Sure. It's the lender, and SBA is guaranteeing the loan. So SBA's requirements to lender is you need to take everything as collateral that can be taken to equal the amount being lent. So if I'm using $1 million to be able to buy a business or to be able to borrow for a business, well, then they want $1 million in collateral. Now, if the business has $1 million in AR, okay, good deal, you're good. But if the business doesn't have the $1 million in AR, then per the guidelines, they should come after personal assets too. So they may have you use your house as collateral. Even they're still a PG, but they may actually start taking personal assets to offset the fact that the business doesn't have enough assets to offset the amount being lent. So it's just something to look out for. So SBA is really good, 80-90% financing to buy a lot of businesses. Not as easy in the digital space where businesses don't have hard assets, right? And then you look at any other different kind of creative ways to either replace that SBA or fill the gap. And that could be anything. I kind of boil this down to three things. It's called the 3C's cash acquisition formula: cash, credit, and collateral. All lenders look at one of three things in your business. That's what they're looking for. When they ask you for this stuff and all these, they just want to know three things. Like, what's the cash flow of the business? And that's why they'll ask for tax returns, P&Ls, and balance sheets. And that's why they ask for bank statements. They just want to know, like, what's the revenue? And then the second thing is credit, like consumer credit, business credit. Those can be leveraged to get money. And the third thing is collateral, like what assets do we have personally or business-wise to obtain money? So when I'm thinking about getting money for any purpose, acquiring a business, building my existing business, I have to be really honest about where are my strengths. Do I have good consumer credit? Great. Credit card stacking, great way to get $150K, whatever it may be, right? Do I have established business credit? Great. We talked about in this interview, like how to use business credit to get all kinds of money. Do I have cash flow? Great. I could use revenue lending, merchant cash advances. I could use PayPal, Square, Stripe loans for $500,000. I can use term loans. I can use SBA loans. I mean, all those things are driven based on the revenue of the business. The more the revenue, the higher the amount I get lent to me is. The higher the amount revenue of the business I'm buying, the higher amount I can get from a lender to buy it, right? Revenue. And then the third is collateral. So what else do we have or that business have that could be used? as an asset that we could leverage against. Does the business have account receivables where customers pay on terms? Does it have purchase orders? Does it have equipment? Does it have inventory? Does it have IP? Does it have trademarks? Does it have a business license? There's a license you can borrow against because I'm an attorney. There's a license I could borrow against because it's a liquor license. Like, I don't know about like where you are or what it was like in Alaska. Down here, these things are like golden
Alaska is insanely expensive. We have a big
It's
drinking
extremely
problem in
expensive.
Alaska.
It's expensive. So
Yeah.
like those things are worth money on the market where people will borrow, where you could leverage that stuff to get collateral. So even your customer list, I mean, things that you wouldn't normally think about is an asset in the business absolutely can be an asset of the business. So we want to think about all those assets the business we're acquiring has. And then we can leverage those to actually get financing to help with the acquisition of the business. Then we also want to be honest and look at our own personal assets and other investors who may be interested. Stocks, bonds, 401ks, IRAs, cryptocurrency, vehicles, luxury watches, art, properties, vehicles. Just almost any kind of asset that a business owns or we own as an individual can be leveraged to be able to get capital. And so that's how we want to think about an acquisition. Will SBA loan work? Yeah. Okay, great. They cover 80, 90% of it. Then what assets do you have or your investors of the business that would be willing to be leveraged that could cover the 10 or 20% along with the seller held note or in place of a seller held note? We can't get SBA. Well, then we pull that out. Now we're more than likely going to look in large part at seller held financing, but we can get them cash by still doing the same thing. Which of these things do we have that are strengths that can be leveraged to be able to get the capital they need to pay for all of it or some of it? It's the easiest way. And then the other type of loan I told you about that most people don't know about is called an SBIC. So with an SBIC, it's basically like a small business investment company. So with an SBIC, SBA will match every VC dollar 2-to-1. So if I go get $1 million in VC money, well, then SBA will give me $2 million. So now I've got $3 million for that acquisition. And this is a really interesting play that a lot of people don't know about, where you could work within VC and SBA and then combine them to actually get even more money. So those are just some of the general strategies on the surface that can help people with acquisitions.
Wow, that's interesting. I didn't know about the SBIC. Does it have to be venture capital, or it can be any like kind of equity investor?
It's private equity, and typically it's venture capital. Yeah,
okay.
Because the way SBA looks at this is like, if you're able to go out and get, a high-end VC.
It's a good trust signal, basically.
Yeah, it's the same thing. And angel investing is the same way. Like if angel investing, when you start a business, there's two kinds. There's affiliated and non-affiliated. Well, affiliated means it's just people you know. And before non-affiliated people want to lend you money, they want to know the people around you lend you money. Because it's just like you said, it's a trust signal. Like if no one around me will give me any money, then like
you're in a bad spot.
Like it's pretty tough to get somebody out of the outside to leave money. So it's just a trust factor, from an SBA. VCs that play that game, if they're willing to invest money and they've looked at it, then it's something that SBA was interested in investing in. So
that's fascinating. I didn't know about it. I have friends they're recovering angel investors. All their deals went south, but they're good. They invest in other stuff as well. But
because of the same parties you're attending. That's why. Like you're part of the reason they're failing. The champagne bottle.
I'm just trying to get them to sell their business and then take all the money and buy another business from me. And, but so let's get into the weeds a little bit here, because one thing, like if you have a business, you can finance all this different stuff like you were talking about, right, to go out and acquire a business. But can you actually use the same kind of power to acquire the business on the strength of that business? So for example, like business making, I don't know, 50 grand a month, you go get revenue-based financing as your down payment on that business.
So the short answer to that is yes. And the longer answer to that is attorneys are involved, and because I can't use the revenue of your business and get money in my bank.
It's like a post-acquisition play,
basically. Yeah, there's got to be stuff like that takes place, right? It could be post-acquisition, or they're coming in. There's things that you've got to have an arrangement worked out with the seller to some point do it after the sale or before the sale, but they're signing for it. There's all kinds of things at a common sense level to think about there. But yeah, absolutely. And a lot of times they do. The people that I help with understanding acquisition financing, that's exactly what they're doing, is they're leveraging, because the seller doesn't care. The seller just wants the money. Right. So if the seller understands, here's the strategy, we're going to use your AR, and the AR is going to do it, but we can't do the AR until the deal is closed. And the agreement says all this, that within, a month, that's going to be leveraged and you're going to get the money type of thing, then yeah, as long as the seller's on board, you absolutely can do it. A lot of acquisitions are done to fill that gap between what they're able to get from financing like SBA to the rest. So the seller has to hold less, if no money, themselves.
Yeah. So my question on that, like, it makes total sense to me. And in fact, we've done a deal kind of similar to that, where technically it was a no money out of pocket deal. Everyone says like, "Oh, those don't exist." Like, no, they do exist. It's just like, does it exist if you're like brand new? Because these are kind of like more complicated deals that I don't recommend newbies to really go after. But if you do this with the business, you take out the revenue based financing, like we talked about. You get the attorneys, get the seller buy in. Does that mean you're doing more of a stock purchase than an asset purchase? Because most businesses we sell are asset purchases, but we have done a few stock sales. But from my understanding, the seller's EIN would be liable for that loan, right? So then he has to transfer that EIN to the buyer, which would be a stock sale. Yeah.
It could be. I mean, in that example, you don't have much assets to leverage, but yeah, I mean, it could be a stock. You're basically going to have access to the revenue of the business because you're going to have to go based on past receivables, right? Or past revenue. So if I'm going to lend money, but it could be the other as well, right? Like, so if it's an asset based sale and the assets I'm acquiring are the future receivables of the business, then those are the receivables. Like the receivables come as a sale, this receivables can be leveraged. So it could kind of go either way depending on how the deal is structured. So that's the easiest way to explain it is it really could go either way. It could be an asset or stock. It just depends on how the deal is structured. And most importantly, the asset being leveraged to be able to get the financing. So for example, if I'm just doing an asset based sale, what does that mean? What are the assets I'm buying? Like, am I buying future receivables? Because revenue financing specifically, which by the way is a horrible example for this because it's really high price money. We wouldn't want to use it for this
Okay.
purpose. But let's just say that we did. Okay. So in that case, like we're buying future revenue. We're basically paying a discounted rate for future revenue that we're purchasing of the business. So on an asset sale, are you getting just the assets or are you even entitled to the future revenue of the business? Things like that. That's where you got to sort it out based on the structure of the deal.
Okay, that makes sense. And if you, let's say if you did do an, so I was talking to, I use revenue based financing because they're top of my mind right now. Because I had this conversation with an RBF firm not too long ago, but I asked them like, hey, like, if a person buys this business and is like historically is doing this, but now now I'm the new owner, let's say, would it still qualify? And they told me like, yeah, as long as we can still run your QuickBooks. So like in this case, in that example, like when you are buying a business, like is that common? They're looking at your P&L and QuickBooks, so you need to like basically get all those historicals in your
Yeah.
new QuickBooks instance or whatever,
100%.
right?
On RBF, yeah, on revenue based stuff, it's 100% looking back 3 to 6 months at what you've done revenue wise. And then their computers project what's going to happen from there. So what they're really looking at is your banks. And QuickBooks is fine. But what they're really looking for in most cases is they're pulling in your banks. They want to know how much you got money going in, how much you got going out. Is the revenue stable? Is the revenue increasing? It's just really a historic look back of 3 to 6 months for their technology to then produce an outlook of what they think will happen, and then they're basically hedging their bets based on that. So yeah,
I see.
some kind of look at typically bank statements, QuickBooks, stuff like that in order to be able to do it. And that's why I say depends on the structure of deal. Because like you've got to know that they're buying a business where with the history is going to be relative to the future. Like if you're just buying assets and it doesn't include the revenue, well then there's no way that kind of deal would work. So it just depends
Sure,
on the deal.
sure. And when I say asset, it's almost always the actual revenue producing asset, right? With the
Yeah.
asset sale, like we just call it APAs, right? Okay, that makes sense. You mentioned RBF is like you want to suggest doing RBF for acquisitions, is that right? Like what would you recommend?
So, I mean, when we look at SBA is long term low rate, and that's the combo we always want. RBF is short term high rate. That's not the combination we want because we just have a shorter time to pay back the money at a higher interest rate. Now, it's okay. I mean, and I'll give you a perfect example. So, one of our companies came in and they're a soft drink company and they bought they bought a bottling company to bottle the drinks. Now, that resulted in like stupid increase to margins instantly, right? Stupid. So like it didn't matter. Like use RBF for that because like instantaneously they made so much more than what the loan cost them. It was just like no brainer. And it was fast, easy money. They got the deal done super quick and it was super clean and easy. So it just depends. Like, RBF isn't bad. It needs to be done in a way where whatever you're doing with that money, it's being used that's going to give you really fast intake and increased cash flow. And that's just one perfect example of how RBF can be used wisely for acquisition.
So RBF would have an analog with say like a hard money loan in the real estate world. Like you're using it to quickly get the cash, fix up the house. you're going to refinance it later. This hard money loan is paid off in like 60, 90 days.
Yeah, and there's not really RBF for that. That's fix and flip, or that's
Sure, just like a comparison, like similar
yeah.
to
In comparison, those are all called. It's all the same thing. It's all short-term bridge loans. So
gotcha.
short-term bridge loans, anything like short-term bridge loans, those are going to work. They're just different purposes. Like RBF fills a purpose. In real estate, there are different kinds of short-term bridge loans that are used specifically for that purpose.
So we're coming up on time, but before we get in the rapid fire section, I did have just a couple more questions. So when a business like a marketing agency that has way less tangible assets, like what would be your approach from there? Like I understand SBA is like the gold standard, but say they did not want to do any PG whatsoever, but they still want to go and acquire this marketing agency. What would you recommend in terms of that?
We'd want to look at cash flow credit collateral. At that point, what is the owner willing to do? Does the owner have assets that are willing to pledge? What assets does the business have that they actually have that we could use? And then from there, we make the decision. But I would start in that case based on assets of the individual or the business. And then I would look at what we can get from that. And then it would just have to be some kind of creative deal structure from there. Can we use the revenue of the business? What assets of the business can we use? On the owner side, what are they willing to do? What's the seller willing to do? Is the seller held note? And it's usually going to be a combination of all those things.
Yeah, that makes sense. Like accounts receivable, I imagine would be a potential solution with an agency.
Sure.
Yeah, something like
Yeah.
that.
Yeah.
Awesome.
And stuff we already talked about, like IP, trademarks, licenses,
Yeah.
customer list, all that kind of stuff could work.
Well, Ty, I know you're running late for a meeting, and I feel like I could probably talk to you for another hour. I really enjoyed this conversation. I'd usually ask a rapid fire section, but I know I've already made you late, so sorry. But for everyone that's interested to learn more about you, Ty, maybe connect with you or check out your software at Credit Suite, where's the best place for us to send them?
They can go to creditsuite.com/EIN. And at creditsuite.com/EIN, we have a step-by-step guide to kind of walk through business credit building. It gives you more details on what credit to get in each tier, better starter vendors, everything they would need to succeed.
Awesome. Well, Ty, we'll put those links in the show notes. And thanks for coming on, man. And we'll have to have you back on. I'm sure we could do another hour podcast soon enough.
Sounds good, Greg. I had a great time. Thanks for having me.
All right, man. Take it easy. There you have it. I hope you enjoyed it. I hope it got you inspired at all the different things that are happening in this industry. And of course, if you just want to buy a highly profitable business, you can always go to empireflippers.com/marketplace, or maybe you want to make an exit of your highly profitable business, and you could go to empireflippers.com/sell your site. I've been your host, Greg. If you enjoyed this episode, make sure you leave a review, give us a like, a follow, share it across social media. Talk to you all soon. See you on the next episode.